Hey
Hello,
man, how are you?
Going on?
Sri. Sri, is that right?
Yeah,
Hey, how you doing?
I'm great. How are
Hey,
you, Max? How are you,
I'm
Ethan?
great. How you
What's going
doing?
on, sweetie?
I'm great. I'm glad to be here.
So, so, what time is it over there? It's Canada, right?
Yeah, it's 9 p.m.
9
Okay.
p.m. Oh, so it's the same thing.
Yep.
So, you read the three questions we sent you, right?
I did. Yeah.
By the way, I wanted to say thank you for um, joining our podcast. By the way, this is our first um, podcast, so it's really extraordinary that we get to start it with you.
Thanks, man.
Um,
I'm glad to be here. Thank you for having me.
Absolutely. Um, yeah, it's also great to connect with a fellow trader. You mentioned that you trade primarily as a global macro.
And
Uh,
I do more like value investing as well. But yeah.
Value invest. So, what's your conception on value investing? Is it the the, the deep Graham and Dodd kind of value investing, or is it the more modern approach of buying value against growth?
So I probably say it's more like Buffett and Munger. So finding a good company that's cheap. So let's say, there's a company that has a massive growth catalyst that's coming along. Like for example, let's say they're about to win a contract with a massive company. Now that's value with a catalyst, and then that provides growth. And the other thing that you could do is find companies that get high returns on equity, high returns on capital, and you could hold them for a very long time, which is Warren Buffett's favorite strategy. And that's what he does for the most part.
And so you take into account the methodology within his strategies and within his uh, investing philosophy. So um, how do you put that um, to reality? What is your not necessarily strategy? We don't want to reveal your strategy here, um, right? But we want some clarification on um, on maybe what process you go through to accept a stock or company that's quote unquote undervalued, whether it's intrinsically. What are your thoughts?
So what I start by doing is, have you heard of Finviz? It's a stock screener.
Of course, yeah.
So,
I
so
use it sometimes.
it's amazing, and it's a great place to start. It's a great place to get started. So you could filter out by various things. You could use return on invested capital, PE ratios, PV ratios, everything. So that's where I get started. I like to filter for companies with high margins and high returns on high returns on invested capital, high ROICs. And so when I do that, it gives me a list of companies, and then I usually look for smaller companies that are below that are below $1 billion, because that's the things those are the things the institutions are not following, and that's where more opportunity is. So if you read Joel Greenblatt, he asked investors to look for smaller companies that you know larger analysts are not following. Like Apple, it probably has like 36 analysts behind it, but then something smaller, it does not. So and then after that, I start reading everything I can about the company, the SEC filings, the earnings transcripts of the CEOs. So, for example, recently I was looking at this company. It's called Collectors Universe, and so what it does is it grades coins and cards. So if you're a coin collector or a card collector, so you can go up to them and then they grade it, and then you could sell it or you could keep it, or you understand what the value is. And so on the most recent earnings call, the CEO was talking about the massive growth by investing in China, by investing in Hong Kong as well. And the other thing was that they have a massive backlog of orders. So that got me very excited about the company. And then the company has amazing margins, very low debt, and it's got great returns on capital. So after that, all that's left now is to read through the 10Ks and the 10Qs, and then see, how has it done so far? Now, what have the CEOs said so far? What's going on? And then after that, at the end, I probably run a discounted cash flow valuation. So figure out what the intrinsic value of the company is, and Yeah. So if it trades significantly below that intrinsic value, you get to buy it with the margin of safety. And you know, after that, you just put money into stock and then you wait.
Yeah,
Yeah, just wait.
that's
So
awesome.
that's very great. Um, Now, let me ask you, Sri, during this COVID crisis, um, do you consider deep value investing to be used as an advantageous situation, or rather an advantageous environment, versus a growth oriented strategy where stocks are consistently beating the market for an extended period of time? What do you think, during this, what I like to call the everything crisis, um, right? Everything's affected. What is the best thing to do? What do people with 401ks, what do people with pensions and endowments, what do they do, and trust, what do they do in response to such a heavy stress throughout the financial markets?
So one thing that they do, so when you talk about value versus growth, Warren Buffett in his book The Essays of Warren Buffett has said that you can't really differentiate between the two, because if you're value and growth, they're all connected at the hip, and then all investing is value investing, because you buy something that's below what it's going to be worth in the future, because that's value investing. You're buying something below what it's worth, and that's growth investing as well, because you're buying something below what it's worth in the future. And so so, so all investing is value investing, but then, over the last 10 years, value hasn't done well. But then the thing is that historically, value has beaten the market. So low PE and low PB has always beaten the market historically. And I mean, that's what I'm doing right now. I'm just trying to find great companies that I can buy cheap. So if you've seen Buffett's favorite indicator, the stock market cap to GDP ratio, it was at 140% before March, and then now it's at around 120%, which is still really, really high. When you look historically, in 2008, it was about 50 to 75%, which was what made it such an amazing opportunity to buy. So right now, it's uh it's around 120%. So I think there's still some downside that's left, and we could still go a lot lower from here, especially because everything's closed, and then we have the highest unemployment since the Great Depression, with the highest GDP decline since the Great Depression as well. So I think, so personally, right now, I'm personally waiting in cash, and I've got a few $1,000s sitting around that I'm going to put to work as soon as I can find some good opportunities in the market.
Great. So me personally, I speculate um, that we will see a currency crisis. The dollar will crash. So I think one of the best investments is gold, and gold mining stocks, gold stocks in general. Um, because it's not backed by fake money, it's not backed by stimulus and bailout money,
Great.
and fake printing. Um, right, that's the definition of inflation, but we've remained at 2% for such a long time. Well, we can't even beat 2% Fed horizon, but we're still trying to obtain a Fed balance sheet while it's exploding. We can't do anything about it because we're buying up the entire credit market in essence. So let me ask you, Sri, if what we're seeing is such an accumulation of debt for the U.S. economy, so for 20 or so years now, in turn to thanks to the federal government, what 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 possibilities of arbitration can one take, can an investor slash trader take, um, for a situation, or long-term situation such as that? What can a trader do to exploit that accumulation of debt into a financial investment?
I get what you're saying. So what do you mean by exploit the accumulation of debt?
So by the accumulation of debt, I mean the government, right? The government, well, we're in national debt of over $20 trillion
Right.
relative to our Fed balance sheet to GDP, which is roughly 30%. So there's quite a contradiction between the sluggish economic growth. The productivity has been subpar. Unemployment's kind of unmeasurable because it doesn't take people on furlough, and
Right.
part-time on board, so it's not really a great indicator. There's a lot more unemployed people than we think. Now with 30, almost basically 30 million people,
Yeah, over 30 million.
over 30 million people out of work. Um, you know, you know, I think some good companies, for example, I'll be answering the question, I guess, first. I think a good example would be, um, banks that have the ability, to stress mortgage financing, right? Because people now at such low interest rates will want to refinance their loans at very, very low rates. Um, we don't have teasers anymore,
Right.
um, but and also create new mortgages, and increase the bank's balance sheet, both regional and commercial. So that's just an example of what I mean here by what can an arbitrager do to exploit the lack of growth in the U.S. economy, or
So
rather
what?
the decline of it.
So historically, what's happened is that during crashes, gold miners really do well because the demand for gold goes up as a safe haven. So, whenever the market crashes, people usually go to gold because it's a safe haven and it's always done well. So similarly, gold miners have always followed. So you go look at GDX, the gold miners ETF. It's historically done pretty well during a market downturn, and that's what we're experiencing right now. And that's something. So gold miners are something that I'm bullish on right now, and I think that could go up. And going to the problem of U.S. debt, U.S. debt isn't really a problem because right now the U.S. is borrowing at about 0.3, 0.6%. Those are the 5-year and the 10-year Treasury yields, but then inflation is around 2%. And so what happens is that, in meaningful terms, it's basically borrowing for free. It's basically borrowing for a negative yield because inflation is higher than what you're actually paying in interest. And so in meaningful terms, US debt has actually gone down.
So right. So, well, for the short term, right, not for the long term. We're looking at a time frame of since 20 years. And the short term, well, lately, I mean, since before pre-corona, the Fed has eased 3 times. So this
Right.
was bound to happen. This just happened to be the biggest pin and most extreme pin of all to pop this. Um, but so, I mean, short-term interest rates have, like you said, inverted to the negative side, like 1 month, 3 month, uh,
Right.
right? So, but do you think it'll come to the point, given our current yield curve, or even the past annual yield curve, what we've seen? Do you think the inversion will commit to more of it, to more inversions? Do you think we'll see it in the short term and the long term? What can a trader do about that?
So what happens is that if you look at the numbers, so what happens is that banks usually borrow on the short end and then they lend on the long end. So they usually borrow at the 3-month yield, whatever that is, and then they will lend on the 10-year yield. And then when it's steep, when the yield curve is steep, then what happens is that it basically generates free money for the bank. But then when the yield curve becomes inverted, then there's problems for the bank because it borrows higher than it can lend out at. And so in inverted yield curves, banks usually do bad, and then most macro traders tend to short the banks because now it's harder for the bank to start lending. So that's one thing that you could do. And then yeah.
Do you
So
think banks are a good investment?
so right now yes, the yield curve is pretty steep. So 3 month is at 0.11 and the 30 and the 10-year is at 0.6, but you know it's still pretty low, and it's not as good as it used to be. So that's one thing. And then the other thing is that if people can't pay off their loans, if people can't pay off if people can't pay off stuff during this coronavirus, they don't have jobs, it is going to create problems for the bank. So personally, I'm just waiting in cash right now. Then when you made the point about the Fed has promised last week that they're going to keep rates at 0% until we reach full employment. And right now we have about 30 million, more than 30 million people, so that's about an 18% unemployment rate. And unless we bring that down to about 2 to 3%, like 3 to 4%, like it was under the Trump presidency, I think about a year ago, you know, it's still going to be 0%. And when it's zero, as long as it's 0%, treasury yields are still going to be extremely low.
Yeah. And so, I mean, yeah, I mean, given the additional stimulus that we're seeing, next will be infrastructure soon, probably. I mean, Senate's willing to pass anything. Um, but I think that, I mean, I wanted to find out, given that you have such a, like we covered briefly, a very macro oriented view, which is fantastic. Um, um, because it's systematic to how you perform as a trader in the short and long term. But how can you tell us more specifically, what kind of trader do you consider yourself, and um, you know, go a little in depth with that, like conceptually speaking, like what you know what um, what alters your mind throughout each intraday trading process, or is it an overnight process? How do you function in time frame? um, all these different kinds of things.
So right now, I find two styles of investing or trading attractive to me. So one is value investing, which I mentioned before, and that's something that's the first kind of investing I was introduced to, and like most people, the intelligent investor, security analysis, Buffettology, and Warren Buffett, Charlie Munger, and finding great businesses, buying them cheap. So now that makes fundamental sense, and that's something I've always enjoyed doing and enjoyed trying to find. The other thing is that and then the other thing that interests me is global macro, because number one, I've always been interested in politics and economics and the way the world works, and I find the styles of investing of George Soros and Stanley Druckenmiller to be really interesting. So,
Yes.
uh, you know, so
Let me ask you, Sri, what's your favorite books pertaining to economics and politics?
so one of them is The Alchemy of Finance by George Soros. I don't know if you've read it, but it's amazing. So it talks of how the efficient market hypothesis is wrong, and how markets really function. Then it talks of self-reinforcing and self-defeating cycles in currency markets and stock markets, and how you can actually profit off of that. The other books that I like are Market Wizards, the whole series. It's amazing. And then I like The
I'm reading
Intelligent Investor.
Schwager right now.
Huh?
I'm reading some Schwager right now.
Hey, it's amazing. Yeah, it's a great series. It's the best series in finance, honestly. And then if you want to go specific to economics, I like Milton Friedman. So he's my
Oh
favorite
my,
economist.
he's my favorite.
Exactly. He's amazing. So Capitalism and Freedom is another great book that I'd recommend people to read. If they just want to understand how society should function and what's the best way it can function to achieve maximum economic productivity. Then several of his principles have held throughout time. So in I think about the 80s or 70s or 80s, countries like Chile, Mexico, Finland, they all had fixed exchange rates, while Milton Friedman recommended floating exchange rates because fixed exchange rates always break down. And Milton Friedman was right, and these exchange rates broke down. There's an amazing paper called Currency Crises that you can find online for free that you could read on the details of these crises. But it's amazing, you know.
Yeah, absolutely. Those are some great mentions. I really want to delve into the point where you made about libertarianism, because I call myself quite the activist for one. Um, so I'd love to delve into this just for a little bit. Um, let's see. I mean, my view is, and please correct me if I'm wrong, or challenge me to whatever, but I think it's, I think that there's a wide responsibility for the U.S. federal government. Well, what I want to start with is the federal government should be limited. It should be extensively limited
Right.
because of how much wrongful things it's accomplished. Each Fed chairman that we've seen, one after the, except maybe exception Greenspan, um, they've all made mistakes. They've all made mistakes because they follow the market and they interpret it as just the market. They don't alter to any speculative movements. They can't. Otherwise, they're risking default, of which we're going to eventually see in the United States. It's really a question of when the United States will see a default. Because you mentioned, Sri, about a currency crisis, and I think we will see one soon. Um, Along with the liquidity crisis we're seeing right now with small businesses. It's all systematically related. But how can the federal government, here's my question to you, Sri, how can the federal government change what it's doing now, change what it's been doing for an extensive amount of decades, and perform in such a way, along with Congress's cooperation and whatnot, how can they perform in such a way that would benefit the U.S. economy, along with potentially the financial markets? Not saying that they're any indication of the economy. I would say they're not. But however, they are their sentiment. But how can, that's the question.
So I don't know if you've heard of this, but there is a form of government called futarchy, futarchy. Have you heard of it?
I have.
So basically, it's kind of like, some of the concepts include like if the politician, he proposes a policy and gets that passed, but then the policy fails to achieve the expected results, then the politician, he doesn't get a salary for a year or something like that. It's kind of similar to that. So, it puts pressure on the politicians to actually pick policies that will work, and, that have a high chance of being successful. And, the other thing is that you could have, futures on inflation. So if the futures on inflation say, if the market thinks that the futures on inflation, that inflation is going to be about 2%, then the Federal Reserve can adjust its policies as per that. So the market, the market is able, because the market is better than the Fed. There's no doubt about that. And and overall, the market as a whole is pretty much closer to being correct than the Federal Reserve. So if the Federal Reserve and the Treasury base their policies on what the market thinks inflation is going to be, so then that's a better way for the Federal Reserve to function, because the market thinks inflation is going to be 2%. Then the Federal Reserve can keep rates at about just above 2%, 2.25, 2.5%, just so that they get that premium over inflation.
I love to see the day when that happens.
It's never going to happen, but
can you imagine that? Anyway, so I guess my last question is, do you believe the market is efficient?
So I don't think the market is entirely efficient, but I think it's a lot better. It's like, as in the free market system or the stock market?
Stock market, we'll say the stock market.
So the stock market is obviously controlled by emotions in the short run. So, there's the concept of Mr. Market and the intelligent investor. So some days Mr. Market is really, really happy and really, really optimistic. Then that's when you sell. And sometimes he's just, he's just outright pessimistic. He's just, he offers you a really, really low price, and then, that's the day you should buy. And that's the way the stock market works. But then from an economic standpoint, I think free markets are a better way to allocate resources compared to state intervention. And I think, yeah.
Praise the Lord.
But yeah, stock markets are inefficient for sure.
Simple.
Yeah.
I mean, that's the definition of capitalism, free market. We shouldn't be able to bail out companies that are, yes, essential to our economy, like Boeing, right? Boeing, 1% of GDP almost.
Yeah. The thing is that, in capitalism, there's both success and failure. But then, what we're doing right now is we're just enjoying the success. And then after that, we're just saying, okay, let them fail. We shouldn't let them fail. And, they're just helping them not fail. And in the long run, this is bad because, you're helping the poor companies that have terrible balance sheets, which is not a good long-term idea. It might work in the short run, can save a couple hundred jobs, but after that, in the long run, from a long run perspective, it's not that good. And the thing is that, that it's a moral hazard for companies. Companies are not going to be like, I can do whatever I want, and now the Federal Reserve is going to save me regardless of what I do.
It's a bad investment on the government.
Yeah.
And then, your point about the currency crisis, the thing that for the dollar, the thing is that the dollar is still the world reserve currency. And as long as it remains the world reserve currency, we're not really going to have a
Yes.
problem.
But let me point out this. If it weren't for and I stress this a lot, if it weren't for the US, right after 1971, if it weren't for Nixon, if we didn't back off gold, the gold standard, no other country would have paper money. It's all because of the US. It's all, every country has adopted printing money and paper money because of the US dollar. There's so much demand, you're right, for the US dollar.
Right.
There's constant demand, especially now. I mean, there's gold and dollar swaps. There's dollar swaps for gold, um, foreignly, which is pretty insane. I mean, these countries are selling all of their gold supply for US dollars. Um, it's remarkable. But I think eventually, honestly, we will go back to the gold standard. Yes, it's a given limited amount of supply, but that's the good thing because that allows a free market flow.
I mean,
Not
the other thing is that, the gold standard, for example, for me personally, I think that responsible fiat money is probably the best way for money to, develop. But then the thing is that, sometimes it becomes irresponsible, like Venezuela and Zimbabwe, and then, we have hyperinflation, or we just have high rates of inflation. So the thing is that, with the gold standard, you're gonna have fixed exchange rates. So, it's fixed in price of gold. If one gold bar, if one French franc is 0.26 gold bars, and one US dollar is like half a gold bar, and then the exchange rate becomes fixed,
right.
and that becomes a problem in the long run, because then all the currencies are connected and they're all fixed. And this is what happened in the Great Depression with the gold standard. So now everyone was connected, and so when the U.S. collapsed, that spread to Europe and the rest of the world, and that's why the Great Depression became worldwide.
But now we've made this problem so extensive. Look at the European Union, right? The euro. Um, I mean, I praise the Lord. I mean, England left for a reason. Now they're out of the euro, so they don't have any support from them. They're on their own, and they've had depression. I mean, they've had recessions before, just like any other country. But the problem is, every country is seeing a form of recession. The U.S. economy is seeing a steep recession because of the stock market fell 25% or so within 2.5 or so weeks,
Right.
right? It would not have, I would argue, it would not have fallen so rapidly, right? It's the most rapid downfall we've seen in history. I would not say that it was rapid because of advancements in technological um, things, but or population in itself, but more so because um, the well, I forgot what I was going to say. Forgive me, but
Yeah. And if you
can you
go
remind
back to the
me what I
EU,
was
so if you go back to the EU, so what happens is that now there the euro, as a lot of people have mentioned, is flawed for one fundamental reason. They have a common central bank, but they don't have a common fiscal union like a treasury or a government. And so so the thing is that now Germany has to bear the different currency risks and the country risks of Italy, Greece, Portugal, and other highly debted countries. And that's bad for Germany. The purpose of the euro was to unite all the European nations and to prevent another world war. But then, after that, the economic consequences are getting out of hand, because now you need negative rates to help all these other countries. And recently Deutsche Bank announced that all deposits over 100,000 euros is it's going to be subject to a negative interest rate. So you're actually going to pay the bank to keep your money in the bank.
right.
it's crazy.
It's insane.
I mean, I like the
Um,
free trade in the eurozone, and I think that's good. And I like immigration as well. I think that's good as well, because it helps richer countries get richer, and it helps overall the economy prosper, because skilled people come from other countries and then they build your country as well. So I think that's a good thing. But then the euro is a flawed concept.
It's funny. I mean, in 1929, that crash, we saw personal taxes go to 70, 80%, right? That's
Right.
extraordinary. It's never been that high. Um, but nobody paid them. Nobody paid them because um, the deductibles were through the roof. Um, but nobody paid them, and that's why ever since, that was the form of this bubble that we've seen escalate. Well, let's take an exception post 1945. Just lack of certainty within how we will deal with the future value of our economy, right? We seem to focus only on the present, not necessarily the
Right.
future. And that concerns me as a citizen. Now, somebody that would move to a territorial location of the US, like Puerto Rico, um, right? They don't have to pay federal taxes. So they're kind of
Free.
advan- yeah, they're advantageous in that sort of manner, and it's a beautiful place to live. Um, but my point is, why should the average American, and I don't want to get into um, you know wage
Okay.
gaps and whatnot, but why should the average person have to pay the taxes they pay to the government? How does it benefit them?
I mean, usually it's usually usually the argument is that they pay taxes and then they get something back in return, some kind of service, some kind of they get to maintain law and order, etc. And then that's usually the argument. And then it says that rich people pay more so that they can help the poor. And then apparently that's a very good moral thing to do. I don't want to get political here, but
I don't blame you.
but then Trump announced that he's gonna cut payroll taxes to to help reboost the economy. And the thing here is that he's already cut taxes in 2017, which is what led to the massive growth in the 3 years of his presidency so far before the coronavirus. And you know the problem with the problem is that a lot of governments right now, they're based on Keynesian economics. So what Keynes said was that in good times you have surpluses and in bad times you have deficits, and that helps keep the economy running. And now the problem is that lots of countries like Canada and the US, what they do is that even in good times, they still run deficits, and in bad times, they run massive deficits. And, that leads to lots of problems down the road.
And boy, do we have massive deficits, um, right? Over a trillion just not long ago. And I think it's only going to exponentially grow, that deficit, until we let things be free.
Right.
Until we let the flow of money be free and ruled by smart and not stupidity.
Mhm.
Um, Capitalism exists for a reason. It's been in existence for 200 or so years. Um, how can, um, here's, I mean, Ethan, I don't know if you want to tap in with anything, but I have one quick question. How can we, um, how can we as an investor pursue, as of right now, during this COVID-19 pandemic crisis, or the everything crisis, what precautions should, say, a person take for, um, you know, just an average 401k portfolio or a joint portfolio, whatever it may be? What can one do to caution themselves going forward if maybe, for example, they're already indexed in some stuff, or they're just in general blends of large and mid caps? What could they do from here on out?
So the first thing that I would say is that number one, don't get FOMO, don't get don't fall into trap or fear of missing out. Recently the stock market in April went up, I think, about 30% from its low in March, and you know lots of people want to start piling into the market, but then you know you might if someone's just dollar cost averaging $500 into an index fund every week or every 2 weeks, I just recommend you just continue doing that, and just stay patient. Just keep the long-term view in your mind. And because as Warren, I don't know, did you watch the Berkshire Hathaway meeting yesterday?
Yes.
Of course. So he talked about never ever bet against America, and the American miracle always works. America will always bounce back from a crisis. So if you have money in American stocks and American index funds, over the long run, over the next probably 5 years, we're still going to reach we're still going to the economy is still going to rebound, and we're still going to go up. I don't know how long the coronavirus will last, but then if you stick with your plan, if you stick with your strategy, and then you deploy capital wherever necessary, if you're picking stocks, or if you're just dollar cost averaging, just continue dollar cost averaging, I think you should be good in the long run.
Great, thank you.
Perfect.
Ethan, you got anything?
I mean, you can't fabricate the capitalistic economy by the government, but as Buffett said yesterday, and proved, I mean, the optimism by the American people and the American workforce, it's there, and a rebound will occur, and it's just a matter of time to see the great innovations that this country can achieve going forward in the future. And yeah, I mean, COVID has put a stop and a halt like we've never seen before, but again, it's only a matter of time before we see what's going on. But in regards to markets, I mean, who knows? I mean, it's been irrational all over the place, and we just need more time to see through the fog, you could say, for people to make the right decisions.
Yeah, I mean, eventually, if you wait, everything's going to clear out, and then we're still going to have good times again. And this is just temporary. It's going to be about, I don't know how long, maybe a year. Hopefully not more than 2. But then after that, it's still going to get normal again.
Yeah.
I mean, historically, we've never had anything like this. We've never had a global lockdown where every single business was closed all over the world. Even for Ebola, or for H1N1, or for the Spanish flu back 100 years ago, we still didn't have everything closed down. So
yeah, we'll see.
All right.
Yeah,
I think I'm out of question. Well, I'm really not, but we just don't have much time here. I could talk to you for some time, Sri. We have a lot in common.
Hours.
A lot of our views are much in line. But no, we don't have too much time, unfortunately. So let me just wrap this up, unless Ethan, if you have any.
No, go right ahead.
I think that we had a pretty productive conversation tonight. We talked a lot about how the average investor can do to perform both now and in general, considering what the market gives us and at that specific time. And you clarified that very, very well for us. And it was a pleasure to have you, Sri. So we thank you.
Thanks for having me. Glad to be here.
Absolutely.
Thank you.